Very good morning, everyone. Welcome to Live Market Sessions. This is Milan Vaishnav. I'm glad to welcome you all today. Just as a brief introduction to myself, I'm Milan Vaishnav. I'm a CMT and MSTA, and I have been engaged in providing independent technical research since last 24 years and have been contributing to the financial media as well. Uh, Today, we would speak about certain important things that would affect our trading day today. We have monthly expiry coming up. That is something that happens every month, so it's a routine. Only thing that we need to take care about are certain options data which would indicate the potential resistances and supports. But there has been an external development which is now going to affect our opening today. That is US imposing 25% tariffs on India. Not imposing, I will use the word slapping 25% tariff because that is something much higher than what other Asian countries like Cambodia and Vietnam and Bangladesh have been able to secure. But that being said, rather than getting frustrated and reacting in panic, we'll try and analyze the impact of that. We'll take a look at the technical setup of Nifty and other indices and certain sectors which are likely to get impacted, and how should we approach the market going on from here. And I'll be more than happy to take your questions towards the end of the session. So let's understand what happened first. Overnight, the negotiations for the tariff and everything are still underway, but failing to reach any conclusive outcome of that, the US has imposed a tariff of 25% plus penalty because we have been trading with Russia, buying the hell lot of oil and military equipment from them, and US doesn't like that, so therefore they have imposed additional penalty over and above the 25% tariff. And but I also believe at the end of the day that it is going the EU way, because since the deadline was approaching, US did slap us with the tariff, but negotiations are going on, and ultimately towards the end of this week or maybe early next week, we could see some more rationalized tariff getting arrived, something more something more reasonable stuff getting negotiated out of this. But as of now, we have this 25% tariffs to deal with, and that could have that will have our markets opening on a negative note. Something very basic to understand that this kind of tariffs, there are certain sectors which get less impacted, some get moderately impacted, and some gets very highly impacted by the tariff. So let me very briefly walk you through what gets impacted the most if this kind of tariffs are here to stay. Would be automobiles and auto components, metals, that steel, aluminum, electronic goods and components, that is smartphones, solar panels. I mean, all sorts of electronics, gems and jewelry. These are all high impact sectors. They are going to get highly impacted. We can see some moderate impact on textiles and apparels, food and marine products, etc. And there are certain sectors which are not only considered to be traditionally defensive here in India, but also are going to be little less impacted, or very low impact sectors, I'll call it. Those are IT and pharma. Pharma stands partially exempt. So we might see certain sectoral play also coming into play. But before we move there, I would first walk you through the technicals in isolation of the external development, and then we will add that external development and see what kind of levels we can expect for the markets to trade in. So I will begin with um, some basic technical discussions about Nifty. We'll walk you through the options data. What does it indicate? Again, this would be in isolation of this external announcement, but we'll incorporate that announcement as well. So Nifty basically had created a trading range for itself in the beginning the month of May, and that range was between 24,500 level on the lower side and 25,100 levels on the higher side. And we had the markets trading in this range for almost 6 weeks before it attempted a breakout later in the last week of June. However, that breakout did not sustain, and we are back inside this trading range. So I can say that the markets are in a very secondary kind of trend. I'll zoom a bit so that the this portion of the chart is visible. But the good thing is that we have not yet violated 24,500. Now, let me stop here and take a look at the Asian markets. Asian markets are trading absolutely mixed. Hong Kong is down. The rest of the markets are modestly down a little bit here or there, but India is expected to see a 1% 1% lower opening. Now, coming back to thing, in my other various interactions, I have been mentioning that we could have some knee-jerk reactions once the tariff issue gets starts getting discussed or something starts getting inflicted upon us. Both the kind of knee-jerk reaction, good or bad, are going to be short-lived because markets ultimately get governed by the broader technicals, and therefore, especially in such turbulent times, it is extremely important that we keep our head in place and know the broader levels that the markets are expected to trade in. So in this case, reading the charts in isolation, we have seen that once the markets are back inside this 24,500 to 25,150 point, that is 650 point trading range, there are two things that we need to keep in mind. One is that the resistances for the markets have been dragged lower. Now 25,000, 25,150. This 150 point zone continues to stay a major resistance for the markets. On the lower hand, as long as we are about 24,500, we will still continue to stay in this broad trading range. Now, let me incorporate this event into this chart. We are expecting around 200 to 30 points lower opening in the markets today. So um, we need to watch the levels of 24,500 because Nifty staying about 24,500 will keep the markets under consolidation. So this is how Nifty is stacked up today. If you look at the options data, we have 25,000 as the level where there is maximum concentration of the call OI, and therefore 25,000 will continue to offer resistance going by the options data. That is something we need to keep in mind as well. So this is how the markets are stacked up for today. If we talk about some sector rotation in this case, then let me open some interesting charts for you. I don't know if that is possible to share here, but let me try. All right, so this is a sector rotation chart, which is as of now that shows that we discussed certain sectors which could get less impacted, and one of them was pharma. And we can see the pharma now rolling inside the improving quadrant, and this is the result of improved relative momentum of the index against the benchmark. That is, here the benchmark is the broader Nifty 500 index. So expect Nifty Pharma to also relatively outperform the broader markets. And besides that, IT is generally considered a low impact sector, but that is inside the improving quadrant. Once again, let me see if I can show that as well. Yes, so we can also see that IT is also inside the improving quadrant. So both pharma and IT are ultimately going to lend some support to the markets in event of any continued negativity in the market. Besides that, we had some negative sentimental reactions from the realty pack. Um, um, in lines of TCS laying off and in lines of the fears that other companies might also well follow the suit. We had Realty reacting in a negative way. But I think the realty, media, PSU banks, metals are taking a bit of a breather in because of stronger dollar. But by and large, along with pharma, these sectors are likely to show some resilient performance, some relative outperformance going ahead from here. So that being said, this is how the markets are stacked up. The only thing is that we are likely to see a negative start to the day, but what we need to focus on is Nifty's ability to sustain above 24,500, and below that we have, in a worst case scenario, 100 DMA placed at say around 24,343. Also, important thing that we need from a pattern analysis point of view, that while the markets were consolidating, there has been a golden crossover on Nifty with the 50 DMA crossing above 200 DMA. So generally, what happens in that scenario, that we do have just, sometimes normal pullbacks in the market, but generally the primary trend doesn't. Just excuse me for a moment. So what I'm trying to drive home a point is that we will have negative opening, but we need to focus more on Nifty's ability to stay above the 24,300, 500 zone. This 200-point zone is a major support for Nifty in event of any continued weakness. So what I'm something else that I'm trying to drive home a point is that one should be, the way to navigate such markets would be to, first of all, not participating in the initial minutes of the trade. We should allow the markets to settle down, and then be extremely stock specific in the approach, and keeping the overall exposure, leveraged exposure at modest levels, preserving the liquidities. Are these are the something extremely basic points that we need to keep in mind as we navigate the markets. There are a couple of comments that I am seeing here, is that One from Ankur Jadhav ji says, should we wait for the first hour's price action before taking any trade? Yes, that's exactly I'm trying to say that do not jump into the trade, do not compulsively trade. Just understand what is going on around. Be extremely stock specific. If you don't have a trade to put today, it's perfectly fine. We would be still able to have a good night's sleep and digest our food. So avoid compulsive trading, avoid excessive leverage, and avoid any speculative trades. Because one thing more, that was on a lighter note, but something more I would like to say is that um, that just a moment. That If we look at the FIS data, FIS have been a net seller of a meaningfully big amount, which is say around 42,000 as of now, as per the data that I have right now. But they are also sitting on net short positions, which are at their 5 months high. So it is extremely likely that may not happen today, but at the end of the day, beyond a point, markets are unlikely to have any sustained directional downtrend. Right now, bear one thing in mind that as long as the levels that I mentioned are not violated, we would still remain in a broadly defined trading range. We would still remain devoid of any directional bias either on the upside or on the long side. So just stay put with something what you have. Keep your portfolios intact. Don't, there is no point in reacting in the first minute of the trade. Allow the markets to settle. I would also suggest that one should allow the expiry to be out of way. We should also allow a couple of 1 or 2, 3 days to be out of way until a clear picture emerges. So that is something I would very, very strongly suggest that we should be doing as of now. Welcome, Saurabh ji. Nice to see you here as well. I hope this session is going well with you all, so you can continue posting your comments and queries to let us know what you want to know about the markets. Uh, we are in next 10 minutes. Um, we would be into the pre-opening, and what another thing that I'm looking at would be to finding relative strength in the market. See what happened. The thing that I'm trying to drive home is that in falling markets, everyone falls. It would never happen that the markets are down by 5% and your portfolio will be up by 10, 15%. It never happens like that. But what is important in such times, what comes into play is the importance of relative performance in the market. Your portfolio would also suffer, but it would suffer less if the relative strong if your stocks are enjoying good relative strength. Now good relative strength will ensure that when the markets rise, your stocks perform very well, much better than the benchmark, much better than the general markets. But when markets fall, or when they are going into this kind of turbulent times, then your stocks tend to lose ground, but they lose very little. They offer tremendous resilience to the portfolio, and that is something more important. So, in my case, I think this is the time that, as and when we need to alter our portfolio or holdings, we should be looking at sectors like pharma and IT because of two reasons. They are traditionally defensive. The weaker dollar plays out well for the IT stocks. IT stocks have suffered over the past couple of weeks, and they are in the process of bottoming out. They have not done so yet. It's a different thing, but one can certainly gradually start looking at these stocks as well. And then the realty has shown us a sentimental drawdown after TCS's announcement of 12,000 layoffs, but that too is likely to stabilize. That sector continues to remain in the leading quadrant of relative rotation graph. That means that it is poised to relatively outperform the markets. When I say relatively outperform, that means that it might also decline along with the markets, but would offer a lot of resilience. and decline less. And then, of course, the pharma. Pharma seems to have shown a completion of a consolidation come bottoming out process. And pharma, unless some monkey business gets done in the US, it is likely to relatively outperform the broader markets as well. So stay defensive, stay stock specific, avoid compulsive reaction, avoid actions out of frustrations. Let the market settle down, let the dust settle, let the week and expiry both go by, and then it would be easy to approach the markets with a more clear mind and less with a mind that is less cluttered. So that's all I have to say for today. I hope you have enjoyed the pre-market session. Leave us with your comments. If you wanted anything more, tell us. If you did not like anything, even then, you should definitely tell us. So with that, I will leave you with this look. I hope to connect with you all again. Thank you very much for connecting with us on this platform. Have a wonderful day ahead. Thank you very much.